entities, most especially manufacturing entities, have this class of assets that they held in their business for more than one accounting period. This class of assets is held for either the production or supply of goods and services, is being held for rental to others. Sometimes they hold this class of assets for administrative purposes. And this category of assets is known or is called property, plant, and equipment. And its accounting treatment and requirement is established in the International Accounting Standard 16. So today, our discussion is going to be based on the International Accounting Standard 16, that is property, plant, and what? Equipment. In short, we call it PPE. So we have IAS 16, PPE. So that is what we are going to discuss today. It was first established in 1982. So IAS 16 was first established in 1982. It was when they have merged IAS 4, which was established in 1975. They have made this one to establish the IAS 16. This one talks about depreciation for accounting. But after the establishment of IAS 16 in 1982, it has received series of amendments and series of revisions. It was currently revised in 2017. It was revised for 2007, 2004, 2014. These revisions or these amendments are necessary just because we want the standard to be consistent with the requirements established in the International Accounting Standard Board framework. The standard tries to address some few issues. The first issue is about the definition of property, plant, and equipment. The second has to do with the determination of the carrying amount of the property, plant, and equipment, how to determine the carrying amount. We also have the issue with the amount to be charged as depreciation, and finally the amount to be charged as an impairment loss. And these issues have been addressed by the International Accounting Standard 16, that is PPE. So without wasting my time, we want to look at what is a PPE. When we say PPE, what are we looking at? So we want to look at the definition of PPE. When we talk about PPE, we are saying that it is an item. In fact, before we come to it being an item, it is a tangible item. That means it is having a physical substance. It's having a physical substance. So it's a tangible item that is held by an entity. So it's a tangible item held by an entity for the production or supply of goods and services, for rental to others, or for administrative purposes. And it will be held in the business. It will be held in the business for more than one period, more than one accounting period. The last clause, that's a PPE must be held in the business for more than one accounting period, actually distinguishes it from from other class of from assets. We know that when we talk about inventory, they are supposed to be held in the inventories. They are supposed to be held in the business for just within one accounting period. Its economic benefits are being enjoyed within one accounting period. That is with inventories. But when it comes to PPE, the economic benefits associated with them are enjoyed for more than one accounting period. It actually distinguishes from other class of assets. So when we talk about PPE, we are saying that it's a tangible item that is held in the business for either the production or supply of goods and services. It's also held in the business from rental to others, also for administrative purposes. And the economic benefits associated with them are enjoyed for more than one accounting period. Another issue that the standard also tries to address is the recognition. It's very, very important. The recognition of property, plant, and equipment. So when should an item of PPE be recognized in the books of the entity? So we want to look at the recognition. So recognition of PPE. The first one is that actually aside the general recognition criteria that the item of PPE is supposed to meet the definition of asset and liability established in the framework, the standard also establishes two criteria that is supposed to be met before we can recognize an item of PPE in the books of what an entity. The first one is that it should be probable that the economic benefit associated with the asset should be what enjoyed by the entity. It should be probable that the economic benefit associated with the asset should be enjoyed by the entity. And then the second one is that the cost of the asset should be measured reliably, or should be reliably measured. These are the two criteria. There are sometimes this criteria is very, very important, because there are sometimes that some assets try to function or try to behave like a property, plant, and equipment, but the economic benefit associated with that particular asset does not flow to the entity. It does not flow to the business. It does not flow to the organization. So in that case, that particular asset failed this recognition criteria, and therefore must not be classified as PPE, but maybe other class of assets. So when we talk about property, plant, and equipment, it should only be recognized in the books of the entity when it is probable that the future economic benefit attributed or associated with it will flow towards the entity, and the cost can be reliably measured. After an item of PPE has met the recognition criteria, then it needs another important feature, which is measurement. Because before you can include that item in the books of the entity, there must be a figure attached to it. And this figure, before you can get it, there must be a need for measurement. And the measurement of a property, plant, and equipment is very, very important, because for you to know the costs or the amount to involve in the books of the entity or in the financial statement of the entity, then you have to measure. So in IAS 16, we have what we call the initial measurement and the subsequent measurement. So it is required. So we have the initial measurement. It is required that all item of PPE should be initially measured at costs. Should be initially measured at cost. And when we say cost, what are we looking at? Cost, we are saying that is a cash or cash equivalent paid. So we say cost, we are looking at cash or cash equivalent paid, or the fair value of a consideration given to acquire an asset at the date of its acquisition or construction. Sometimes, where applicable, we say that it is the amount that is attributable to that asset when it was initially recognized in accordance with the specific requirement of other IFRSs. So this is the definition of cost. So here we see that it's a cash or cash equivalent. So we can use cash, or we can use cash equivalent like demand deposit to acquire an asset. That is the cost. Another thing that was mentioned in the definition of the cost was fair value of other consideration given. This means that sometimes an entity can exchange an asset for another asset. So I'm trying to explain the definition of the cost. So we can exchange, let's say an entity has a vehicle that it has used for some time and want to change it with a new vehicle from another entity. So maybe this is from entity A and this is from entity B. From the definition of cost, that is what we are trying to establish. Now, this can only be possible when there is enough information about the commercial substance pertaining to the asset given for the asset that is going to be taken out. So if there is no commercial substance, there is no information about the commercial substance of the business, then we cannot use the fair value. Okay, so we have to basically if you want to exchange an asset for an asset, we use the fair value measurement. And before this fair value measurement can be applied, then the commercial substance, the information about commercial substance, about the entity, about the vehicle should be known. And also, there must be more evidence that we can value the asset that is given out and the new asset that is being exchanged for. If there is enough information about the commercial substance, then we can go ahead and fair value the asset. This means that, assuming this one is the asset, the new one, and this is the old that is being exchanged for. If we know the fair value of this to be $2,000, and then the old one, we have used it, we have depreciated it, so at the day of our exchange, the carried amount of the asset is, let's say, $200. If that's the case, now the cost of the asset now become the new, where we would take this one from the books of the entity. That is about exchanging one asset for the other. So this was mentioned in the cost. That's why I take my time to explain in a case where an entity wants to exchange one asset for the other. Now that we have known that we can exchange an asset for the other, we want to look at the element of costs. With the element of cost, we can have it for two class of item of PPE. We can have element of cost when we want to acquire the asset. So in the definition of cost, we realize that it is either we acquire it or we construct it. So we can have the element of cost when we want to acquire the asset, or when you want to construct the asset. Always remember that with the element of cost, only the cost to be capitalized or to be involved or to be captured at the cost of the asset must be a capital cost, but not a revenue cost. So in this case, we have two types of cost in here. So we have what we call capital costs, and then we have what we call revenue cost. So remember that it is only capital costs, they are supposed to be captured as the cost of the item. And what are some of the examples of this capital cost? First, we will take it when we want to acquire the asset. When we want to acquire the asset. So in this case, we are looking at the purchase price. So I'm going to use initials. We are looking at the purchase price. And if there is any trade discount, we less it. You will deduct trade discount in case there is any. And then we will add import duties or import tax. Import duties or import tax. And we again add non-refundable sales tax or non-refundable tax. So this is the first one. So we have the first element of cost in the case when we want to acquire the asset. Is the purchase price. If there is any trade discount, we less it. If there is any import duties or import tax, we add. If there is any non-refundable sales tax, we also add. But please, there are a few things you are supposed to note here in case you have a practical questions in front of you, especially under the non-refundable sales tax. You see, if the non-refundable sales tax is not included in the purchase price, is not included, is separated. So assuming the purchase price is $100 and this non-refundable sales tax is $50, is not included. That is where we are supposed to add it. So that in this case, you get $150. But in a situation where this non-refundable sales tax is given to you and we have been informed that this amount is already embedded, it's already in the purchase price, please, you don't do anything to this amount. In this case, the 50 is already in the purchase price, so you don't do anything to that amount. You don't take it into consideration. You leave it aside because it has already been added to the purchase price, depending on what you've been told in the question. Again, sometimes you'll be given what we call refundable sales tax. Refundable sales tax. If you are given refundable sales tax, these are the few another exceptions. If you are given refundable sales tax, let's say the refundable sales tax is 20, and you have been told that the refundable sales tax is included in the purchase price. This is not non-refundable, but this is refundable, so it is included in the purchase price. In this case, before you can get the cost of the asset, you have to less that refundable sales tax of 20. So we are going to get $80 to be our what? To be the cost or the purchase price or the cost of what? The asset. That is in the case where we have refundable sales tax included in the what? In the purchase price of the item. Again, if you have non-refundable sales tax and it is just lying like that, it is not included in the purchase price. It's just lying like that. What do? We don't touch it at all. We don't treat it at all. So if you have a refundable sales tax which is not included in the purchase price, but it's just lying idle, it's just in the question, you don't touch, you don't treat it at all because it doesn't form part of what? Of the cost. That is the first thing and the first exceptions to the element of costs. The second capital cost or element of cost supposed to be captured under the when we are acquiring the asset is all other costs that is directly attributable to bringing the asset to the location. And so first, all other costs directly attributable to bringing the asset to the location of the business, and all conditions that is necessary to be capable of making the assets operate in the manner intended by management. So we are saying that all other costs that is necessary for bringing the assets to the location, and conditions that is necessary that is to be capable of the assets operating in the manner intended by the management must be captured here as part of the cost. And this cost, examples of this cost include delivery costs, which is also known as carriage inward. So we have delivery cost in there. This is under this one, delivery cost. We have installation costs. We have site preparation costs. Site preparation. We can also have installation or assembly costs. We can also have what we call legal fees. Okay, legal fees or professional fees is also captured here as part of a direct costs. And then we also have the cost, which is testing costs. After you have installed the assets, you want to test it to see if it is functioning well. That cost that you incur in testing for the asset is also captured as the cost of the asset. But there is some few exceptions. There is some few things you are supposed to note about the testing. If you are testing for the asset and you have produced some goods, you are testing for the asset and you have produced some goods, then we are saying that whatever goods you have produced, the amount of sale you are supposed to less it from the testing amount. So assuming that you test for the asset and the testing cost is $100, and then when you are testing, you produce an amount that can be sold for $20. In this case, the goods that you produce during the testing period should be taken from the testing amount, testing cost, before you add the rest of the amount as the cost of the asset. So these are some of the few costs. They are not exhausted. We can have more of this. So these are some of them, and the second one, the cost that is directly attributable to bringing the asset to the location or condition necessary for making the asset operate in the manner intended by management. And then the third cost we are going to capitalize or capture is the dismantling cost. Sometimes it is required by law that after you have installed that particular asset and you have finished using the asset, you should restore the area, the location to the previous state before you install your asset. So all the costs that we are going to incur in dismantling the asset, in removing the asset and restoring the location to its previous state, those costs must be captured as part of the cost of the asset. And in this case, we call them dismantling cost. But remember that this is a future cost. It's going to happen in the future. It's not happening today. So sometimes the entity will give you an effective interest rate that you unwind. In fact, you will find the discount at the present value of that figure. before you add it to your cost. But in the case where you're not giving those effective interest rates, then you just go ahead and add it to your cost. So the last one is going to be our dismantling cost in here. And remember the issues about dismantling cost. So these are the few costs, or in fact the capital cost supposed to be captured or capitalized when we want to when you want to find the cost of an acquired property, plant, and equipment. In the case where we want to construct the asset, that means self-constructed property, plant, and equipment. Sometimes entities do construct their own asset. In this case, we are saying that if you want to construct your own asset, then all these must also be taken into consideration: the purchase price of the material, the direct labor, and all other costs directly attributed to the construction of the asset must be captured. But another thing that you are supposed to capture under the construction, in addition to this one, is what we call borrowing cost. Borrowing cost, and this borrowing cost is established, or has its accounting treatment established in IAS 23. Borrowing cost. In fact, we capture borrowing cost on qualifying assets. That is when we are constructing the asset, and there is any borrowing cost, you have to capture it as a cost of the asset. So these are the few things you are supposed to consider as the element of cost when you are looking for, or when you are acquiring the asset, or you are constructing the asset. So what are some of the costs that are not supposed to be captured? We are looking at the cost of opening a new facility, or doing a business in a new location, or doing a business with a new customer. All those costs are not part of the cost of the asset. They can be treated as an expense in the P&L account. Making or the cost of manufacturing a new product, all those costs are not part of the cost of the asset. Another cost that is not also captured is administrative expenses, or general expenses, general costs. All those costs are supposed to be expensed, because they fall under revenue cost. They don't fall under the capital cost. So that is it for the element of costs. So we want to solve the following questions to help us better understand the element of cost. So the first question we are going to look at is the one projected on the screen. They said the list price of the machine. They said Albert PLC purchased a large item of plant, and the following costs were incurred. So this one, the plant was acquired, the property, plant, and element was acquired. We have sales price of the machine. We have refundable sales tax included in the purchase price of the machine, which is supposed to be 5. We also have trade discount given to be 50. We have delivery cost, we have installation cost, cost of site preparation, we have architect's fees, we have administrative cost, and we have test run cost. We were given some few information after all these figures. They said the test run cost to ensure that the asset was installed and working correctly. So item of inventory produced. So during the test period, they produce some item, and this item can be sold for how much? It can be sold for $10. And then they said local government officials have granted the company a license to operate. So this one, they said after everything, the company has to recognize a liability of $250 in respect of expected clearance. This is all I was talking about the dismantling cost. The requirement is how much will be recognized in the books of Albert PLC at the cost of the plant. So here we want to look at the cost of the plant. So what will be the cost of the plant? That is our focus. Cost of the plant. So remember that. So let's have this one here, our currency sign here. So the first one is the list price of the machine, but this list price of the machine must be adjusted. So we have the first, also known as the purchase price. So I'm going to use initials for our time's sake. So we have we have our purchase price of $1,000, and the next item is refundable sales tax. And what is the clause beside this one? They said included in the purchase price of the machine. This refundable sales tax is included in the purchase price of the machine. This is not a non-refundable. It's a refundable, and it is included. So what do? We have to take it from it. So we have refundable sales tax of 5. So it needs to be taken off. If it has to be a non-refundable sales tax and it is included here, that one we don't add it at all. We don't treat it. But this one is a refundable sales tax, which is included. So we have less it. Again, if it is a refundable sales tax and it is not included, it is line item, that one too we don't touch it at all. And then we also have trade discount given. Remember I said trade discount, you have to what? You have to less it from the purchase price. So we have a trade discount of how much? We have it to be $50. So we less that one too as well. And then we have what we call delivery cost, is a cost to be captured. So the delivery cost of what? Of 100. We capture it, we add. We have installation cost, of course, is supposed to be added, and that installation cost is $125. We also have cost of site preparation. So cost of site preparation is also supposed to be what? To be captured, and that amount is what? Is 200. It's 200. And then we also have architects what? Fees. That is the same as professional fees, which is 15. $15. So architect fees. And then we have administrative costs. Please, administration cost or administrative cost is not a capital cost. Those costs are supposed to be directly expensed in the P&L account as an expense. They don't form part of the cost of the asset. So in this case, we are not going to capitalize the administration cost. And then we have test run cost. Like I said earlier on, test run cost. The cost actually is 75. But we were told that when they were running the test, they produced an item which can be sold for how much? Can be sold for $10. This was in the additional note. So we have to first take that 10 off before we can treat the rest as what? The cost to be captured. And then the last one talks about dismantling cost. So we have dismantling cost to be how much? To be 250. So when you sum everything up, you let this one and you sum this one up, the total value that you get becomes the cost of the assets. So if you add all this, you let this one and add all this, the total value of $1,700 becomes what? The cost of the asset. So this is when we acquired the asset. Let's look at the next example in the case when we want to construct the asset. Right. So in this case, the second example talks about when we want to construct the asset. And the question on the screen says that RONAS PLC started construction on a building for its use on 1st March 2017 and incurred the following costs. So the purchase price of the land, we have trade discounts. When they purchase the land, they give them trade discounts. We have stamp duty, we have site preparation and clearance, we have materials, we have labor, and they have given us the period for the labor. We also have the architect's fee, and then we also have the following information. We have the general overheads also there. They said material costs were greater than anticipated. So the material cost listed out there was greater than expected. And then on investigation, it was found that the materials costing 10 million had been spoiled and therefore wasted. And then further 15 million was incurred on materials as a result of faulty design. So we have about $25 there, or $25 million there being wasted or spoiled materials. So we will look at how we will treat them. We also have to say that as a result, that's the second additional information. As a result of this problem, work on the building ceased. So that means labor didn't work, and the cost of the labor at that period that it ceased was what? $9 million. It said the building was completed on 1st June 2018 and occupied on 1st September 2018. So you are required to calculate the cost of the building. So here is a self-constructed cost. Remember that you only capture the costs that are directly attributed to the construction of the asset. Any other cost is supposed to be expensed in the P&L account as well as an expense. So in this case, you want to look at the cost of the building. So this one we are constructing the building. Let's have our $sign here. So let's start from the scratch. So the first cost is the purchase price of the land. The purchase price of the land. So let's bring $1 million sign here so that we can do away with the zeros. So the purchase price of the land. So purchase price of the land was how much? It was 250 and 250, and we're giving trade discount. Remember that trade discount we are going to less of 400,000. We have stamp duty here. Stamp duty is supposed to be captured. So a stamp duty. So we have a stamp duty of 5 in there. We have legal fees, of course. Legal fees is supposed to be captured. So we have legal fee of 10 in there. We also have site preparation and clearance. Site preparation and clearance to be 18. So site preparation to be 18. And then we have materials. This is where the issue is. Material. The value given to us is 100 million, but there is an issue with the materials. We were told that some materials were damaged, and the first one was 10 million, and then we also have 15 million. Please, anytime these materials are damaged during the construction of the asset, it's supposed to be taken care of. We take it off. So here we will less the 25, the 10 plus the 15 will give it 25 before the rest will be treated as what as the part of the asset. And then the next one is the labor cost. So this one is the material cost, and we also have the labor cost. So with the labor cost, we were told that there was because of the spoiled material, the spoiled design, the work ceased for a period. So the period which the work ceased, the labor didn't work. So those costs incurred on labor are not directly attributable to the construction of the asset, and therefore must not be included in the cost of the asset. So what we are supposed to do is that we take it from the labor cost. So the labor cost given to us was 150. So we will let the 9 from it, and this will give us $141. So this will be the cost to be captured. Remember that the trade discount, we will less it, so it's supposed to be in brackets. And then, so if you add all these, the total value that you get becomes the cost of the asset. So these are the few things you're supposed to take into consideration when you are looking for the element of cost under property, plant and equipment, that is IAS 16. We now want to turn our attention to subsequent expenditure. So after the initial measurement, if you subsequently incurred any other cost on that particular item, should you capitalize it? Should you capture it as a capital cost, or you should capture it as as a revenue cost? So let's look at some few exceptions. So we want to look at subsequent expenditure, or we want to look at subsequent costs. So subsequent cost or expenditure. Now, this is the general rule. The general rule is saying that if the expenditure is repairs, general as repairs and maintenance, if the expenditure is general repairs and maintenance, this particular cost should be treated as as an expense in the P or L account. But any other cost that will be incurred, that will expand the lifespan of the useful life of the asset, that will increase the useful life of the asset, or that will bring more economic benefit of the entity, which expand the economic benefit of the asset to the entity. Anytime such an expense is incurred, then we are saying that those expenses should be capitalized or should be captured as cost of the asset. An example of such costs will be replacement cost. Replacement cost. So replacement costs are not supposed to be expense in the PL account as an expense, but subsequently when you have these costs incurred, because it's going to expand the useful life of the asset, then this cost is supposed to be capitalized, or it's supposed to be treated as a capital cost. Again, we also have inspection costs. Inspection costs. Inspection costs, some items like aircraft, when they land at a particular airport, they are supposed to be inspected. Unless that inspection is incurred, the aircraft will not be allowed to take off. So any inspection cost incurred on an aircraft or an overhaul, inspection on an overhaul should be captured as part of the cost of the assets. So remember that inspection cost is supposed to be captured or treated as as a capital cost, but not as a revenue cost. Again, we have what we call component part, major component part. So this will probably fall under the replacement cost. Replacement cost is when we are trying to replace a major component. There are some items or there are some property, plant and equipment that have major component parts. So once you want to replace those major component parts, the carrying amount is supposed to be taken care of, and then the one that you are bringing in is supposed to be captured as the cost of the assets. So that is it about subsequent expenditure. After you have initially recognize your asset at each cost, if you incurred any subsequent cost on it, if you incur any cost subsequently or any expenditure, it depends on what the treatment. The general rule is that if it is general repairs and maintenance, which is not going to expand or increase the useful life of the asset, then that particular expense is supposed to be treated as what expense into P&L account straight away, or as a revenue or cost. But in a case where these expenses is going to increase the useful life, is going to increase the economic benefit in the plant or in the asset, then in that case you are supposed to capitalize it or treat that particular cost as as a capital cost. So let's look at the example on the screen. So with the example on the screen, we are told that a piece of machinery has an annual servicing costing. So annual servicing costing, you see, so this is annual servicing costing of of $10,000. So, and during the most recent service, it was decided to replace part of the engineering, meaning that it will work faster. You see, so now during the most current servicing, they want to replace a component part which will work faster and produce more units. But with the servicing, it didn't add any value or any useful life, any economic benefit to the asset. But once we want to replace it, it's going to increase what they said faster and produce more units of products per hour. And the cost of the replacement, so we have two costs in there. We have $20,000 and $10,000. The cost of the replacement is $20,000. What's the requirement? Will this expenditure be treated as capital or revenue expenditure? So you want to see between these two values, which of them will be treated as as capital expenditure or a revenue expenditure. In this case, it is obvious that the first one, which is just a servicing cost, should be treated as your revenue cost. In other words, you expend this one straight away. It's not supposed to be included in the cost of the asset. But since this one is going to increase the product, the lifespan of the asset, the machinery, is going to aid the business to get more economic benefit from the asset because of this replacement, then this one should be treated as as a capital cost, or should be added or capitalized as part of the cost of the asset and included in the statement of financial position as cost of the machinery. So you treat this one, which is just a servicing cost for probably for maintenance and repairs, and this one is a replacement of a component part, and therefore this one is supposed to be treated as capital cost, and you treat this one as as a revenue costs.